Hello, guys. This is Vinit again. Today is the 29th of July 2024. It's Monday morning. And on the weekly update call this past Saturday, one of our regular listeners and who joins on a weekly basis asked me to do a video on what is the yield curve. And this is a term that is thrown away a lot in the financial markets, and I don't understand why they try to make things so difficult and to understand for a normal folk. Maybe it's they want to portray that, hey, by throwing these terms, they look sophisticated. I don't get it. So I just want to demystify all this yield curve crap that these economists just keep throwing out in the financial media, and I want to simplify it for people like you and I to understand what they really mean when they're saying, oh, yield curve is inverted, so recession is about to happen and this is XYZ. So let me simplify things for you. So let's look at two terms right now. Treasury, what is the treasury? Treasury is the bonds that or letter of credit that government issues. So government is borrowing money from the banks, from the public, and they get auctioned. So based on the maturity date of the bonds, these treasury bonds, they could be a 1 year, 2 year, 10 years, 20 years. They have different maturity dates. So the current maturity date 2 year bonds, the treasury bonds, are yielding 4.36% per annum per year. So if you hold it till maturity, you will get the premium based on 4.36% annualized. On the other hand, if you hold a 10-year treasury bond, you are going to get 4.2% annualized. So it's counterintuitive, isn't it? So now the longer term bond you would think would pay you more, and that's how usually it is. And the shorter term bond should pay you less because you're holding it for less time, your risk is lower. So now why is it like that? So you must be asking that question to yourself. Why is it like that? Because it's one of two things. One is that people are expecting interest rates to actually go lower in the long term. So they don't want to pay the high up. They would rather pay high up front, and then they're expecting to fall lower, so they want to pay lower for the long term. And the second is that people don't want to hold money for the short term because everybody is going long term. There's a lot of bid for the long term bonds, and nobody wants to hold money for the short term. Is why short term rates are really, really high, because government is issuing bonds and nobody's there to buy. It's simply demand and supply. And coincidentally, what happens is when the short term rates are higher than the long term rates, coincidentally, in the past, it precedes a recession. So this is the chart where the short-term rate. So the chart is the difference between the long-term. Usually the rate would be higher minus the short-term. Usually the rate would be lower. So that's why majority of the time, say 95% of the time, the line is above zero. So that means the long-term rates are higher, the short-term rates are lower. But that 5%, the difference is actually lower. It's negative because right now 4.2 minus 4.36 is minus 0.16. So that is negative. So what that happens is, if you look at in 1980s, so it preceded a recession. So anything that's in gray is a recession. So here in late 80s, there was a severe recession in 87, 88. Here, it preceded a recession, and the recession is the gray area. Again, in the early 2000, 2001, just a dot-com bubble and the dot-com crash, here it preceded a recession, here is below 1. Again, in the great financial crisis, again is below 1. And there was a recession as the COVID recession happened, again here just marginally below 0. Sorry, not below 1, below 0. And here, look at it now, how deeply it is below 0, and it's actually below 1. So at its worst, the differential was 1. So now, again, it's headed up and it's preceding, is showing a recession is dead ahead of us. And it's not going to be a mild recession. It's going to be a severe, severe recession based on the past history, the way things have been. So I hope I've clarified what yield curve inversion means, what a yield curve is, and how it's used by these economists to actually forecast these recessions. And by the looks of it, the recession is going to be a very, very severe. And so, guys, if you want to save some money, if you want to put some funds for the rainy day, because rain is about to arrive, a rainy day, rainy weeks, rainy months are about to come. I would say no later than 6, 9 months max, or even earlier. So it's the symptoms have started to show. Symptoms have started to show in all the periphery countries. For example, Canada. Canada is going down the shitters. Australia. Look at China. How China is slowing down. China is in a recession, and because China is in recession, Australia is in recession. And now the U.S. is going to go into recession. Canada is already going down. Mexico is the next target. South America is going to follow all of that. So the entire world is now we're going into a downturn, which in my opinion is going to be a very severe downturn. And I would rather have my followers and people who are following my work here at Edge Forex, be prepared and start putting some cash aside. If you are heavily into the markets, traditional stock market, start lightening up because I think this is the last hurrah for the stock markets and they're headed down. So I have done some more analysis on that in different videos, but I just wanted to warn you guys. So this is like a warning signs, telling you guys that hey, bad times are ahead of us. Severity of it, nobody knows. But by the looks of it, I think there is a lot of excesses that have built into the system. A lot of investments have been done because of all that money that was created during the COVID downturn. So to counter all of that, you need to have a recession. A recession is a cleansing process where all the excesses of the system are cleansed out. So the greater the excesses, in which my opinion they are, the severe or really tough the cleansing process. Imagine you've been drinking alcohol for years and years and years and years. Eventually, one day it's going to catch up to you. And when you go through that detox process, so the longer you've been drinking, the longer is going to be your detox process and the more pain you'll have to endure. And then, but the problem is people don't understand that it's a cleansing process. And at the other side of it, you'll be much more healthier, you'll be much more productive. Same goes with the economy. So the longer it's carrying these toxins, which is the excesses in the system, the more painful the detox is going to be for the economy. So that's what people do. And these central bankers, they want to prolong the good times and they want to shorten the detox times. So what happens is not all of the excesses are flushed out properly from the economy. So now you're starting the new phase of uptrend, but you're starting with a lot of toxins. So the growth is not there to its full potential. So I hope I'm making sense with the parallel. So let me know in the comments how if I made sense, or if you have any more questions, or if you would like to add to it, or if you like me to cover more topics like this. I would love to hear from you guys. All right, I'll talk to you soon.